Most traders lose because they misunderstand the market. They don't understand what the market is doing, or they have no strategy. By watching this entire video, you're going to understand what the market is doing, okay? You're going to have a clear overview what some ICT concepts means and how my strategy works, okay? So before I explain my strategy, I'm going to explain you some ICT concepts and concepts I find very important. This YouTube video is going to be like no cut, no editing, no nothing, pure educational, okay? So pay attention, take a paper, take notes, because this is something like the trading industry does not give for free, and I'm just dropping it, like, you know what I'm saying, and it took a lot of time, okay? So please also make sure you subscribe, join my free Discord group, leave a like, and let's get right into it. So the first thing you do when you go on TradingView, when you're ready to trade, you need to understand where the market is going, okay? So market, very easy, it goes two ways, either up or down, or it consolidates. Basically, market moves like this. I'm going to show you here with a tool so you see a visual overview. As you can see, market either goes up like this, okay? You have highs, lows, highs, lows, highs. So here you can clearly see, wait, let me put it here so there's a better overview. Here you can clearly see market is going up, okay? You can clearly see if highs, lows, highs, lows, highs, lows. You get me? So market goes up. Market can go down, where you have lows, highs, lows, highs, lows, highs, lows, and you get me? Market clearly goes down. But what market also can do is consolidate, range. What does that mean? When price action has no significant move. When price action stays in a range, you have maybe highs and lows on the lower time frame, but on the higher time frame, market isn't really doing anything. Now, if you're a day trader or swing trader, this is the type of market you want to see. If you're a scalp trader, this market is still tradable on the higher time frames. So if your higher time frame is ranging, you can still trade. Now, if your market is doing this on the 1 minute or the 5 minute, it's way harder to trade, okay? So that's the first thing you gotta know. Market goes up or down. Now, how can you know, like, when does it go up and when does it go down? Very easy, okay? Right on the paper, there is two terms you gotta know. There is break of structure. I'm gonna put it a little bit bigger so you guys can see it. There is break of structure, okay, BOS, or you have your change of character like this, okay? So there's two terms you gotta understand to understand where market is going. Break of structure is when, for example, in an uptrend, you have a high, a low, when your new high breaks the previous swing high. This means here, as you can see, this high right here broke above this high, so this means there is a break of structure. A break of structure is like a continuation. You continue with the trend. So here you have a clear overview. Okay, the market did a new high, so you still want to go up. So what do you expect? You expect price action to go down and then to continue to go up. Okay, that's how break of structure means. Break of structure, again, it means when it, for example, in an uptrend, it break your previous swing high to make a new high, where market confirms you, okay, we are in a bullish trend. But break of structure can also mean in a downtrend, when, for example, you have a low, a high, okay, when your next low breaks under your previous low, so that means it broke under this swing low, which means that's a break of structure. Market is clearly showing you, market is clearly telling you, okay, it wants to go down. Every time market structure breaks its previous highs in an uptrend, you know it's going with the trend. There's a continuation pattern. If it breaks the previous low, you know it's bearish, it's still bearish, and you continue with the trend. Basically, you expect a pullback and then it goes down more. Now, before you question, like you ask yourself, okay, when do you know how to trade, or like when do you enter? Don't worry, I'm going to explain way later. Okay, so that's break of structure. Write this on a paper because it's very important to understand how the market goes. Change of character means literally a change of character, a shift of structure. For example, again, you have your high. Let's say you're in a bullish trend, in an uptrend, a low, a high, a low, okay, a new high. But instead of making a new low and then going more up, it closed under your previous swing low, where market tells you there is a new trend and there is a shift of structure. And then usually market, what is it gonna do? Is gonna retest it and then go further down. Okay, so basically break of structure is a continue with the trend. Market shows you it goes with the trend. If you're in uptrend, it breaks your previous swing high, you go further with the trend, meaning you go bullish. Change of character is if it breaks under your previous low in a bullish trend, like here, it means there's a shift of structure and that's a reversal. Continuation, reversal. Let's show on a real chart here. First, before we start, I know the colors is different with me, so I'm going to type it here again. The black color, black is bearish, and on your chart it means red. The white is bullish, and on your chart is probably green if you have the basic colors. Okay, I just put it here so there is no misunderstanding. I just like those colors more, visually way better. Anyways, here you can clearly see we are in an uptrend. Okay, pause the video and tell me, why is this an uptrend? Show me with your finger, like show it for yourself. As you can clearly see here, you have a low, you have a high, a low, a new high. As you can see here, this high right here, there is a body closure above, my apologies, where market is showing you, okay, it broke above previous swing high, so we continue with the trend. Okay, so let's draw again. So again, you have your low, you have a high, you have your low, you have your high, you have your low, and you have your high. So as you can see clearly here, every time market close above this previous swing high, it continues with the trend. Look, low, high, it closed above this, you know. So there you can clearly see this is a break of structure and continue with the trend. This chart is EURUSD, it's Forex, but you can clearly see also here on NQ. For example, here perfect. We have a bearish example where you have, for example, your low, high, low, your high, your low. Every time you guys gotta understand, a confirmed break of structure is when it body close under the lowest wick. So here, this is internal market structure. Okay, you have highs and low on the 15-minute, for example, but that's internal shift, like an internal market trend. Okay, this doesn't mean anything like this here. You don't look for longs because market is still bearish. If you want to look for a long here, you need to close above this wick. Here we can clearly see market is still down, still bearish. If that makes sense, tell me in the comments. Back to a Forex chart. Let me show you an example of a change of character, meaning there's a shift of structure. Let me show you here on the chart. As you can see, here is a clear example. You can see here we go from bullish to bearish. Now how can you spot this? Very easy. If you struggle, use this tool and you just draw the lines. Low, high, low. Here you can see body closure above this previous high, meaning we're still bullish. You have a low, a high. What do you expect when you're in a bullish trend? You expect a low, like here, and then goes up more. But look, it failed to close above. It consolidated, and what happened? It closed here under, meaning this is a change of character. There's a shift of structure. Market is telling you we are not bullish anymore. The buyers are not the strongest people in this market anymore. It's the sellers. So you have a new low, and here new high, low, high, low, high, low, high, and you get me. And if I put this here in the middle for a better overview, as you can see, hold on, okay, like this. Okay, don't pay attention to the line, that was for example purposes, but we can clearly see you go from bullish to bearish. Does it make sense? Exactly. Now, how do I determine my daily bias? Okay, this is for the scalp traders. If I scalp trade, that's how I find my daily bias. If you want to day trade or swing trade, skip this part. I'm also going to explain how I find my bias when I swing trade or day trade. For the scalp traders, very easy. Even a 5-year-old can understand. Pay attention. You go on your daily time frame, and very easy. Here you can see the daily time frame here closed bearish and it grabbed this liquidity. Okay. Then the next day here, it grabbed the liquidity, but it failed to body close under the previous low. That means this day was 100% going to be bullish because it was going to take your previous highs. So every time your daily candle close above the wick, for example here, so with the trend, for example here, it closed above the wick, you know this day is going to get those previous daily highs. Again, here it closed daily body closure above this wick, you know this day is going to grab those previous daily highs. Again, here body closure above, so you know it's going to get those daily previous highs. Okay, here body closure under. Okay, so this is an exception. This is one of the only exceptions, so it's 90% of the time it works. Usually my bias would have been here bearish, so either I wouldn't have traded because market structure is showing something else, or I would have got a loss. Maybe, who knows? You get my point. Look, every time body closure fails to break under your previous structure, for example here, it failed to close under this wick, so you know this day is going to be bullish. For example here, failed to close above, so you know this was going to be bearish. Here, failed to close under and grab the liquidity, so you know this was going to be bullish. Here, close above, so you know this is bullish. Above closure, bullish, and so on and so on. Very easy. Basically, if you're in an uptrend, if your daily candle grabs previous daily high, okay, and body close above, you know the next day is going to be bullish. If it fails to close above, you're going to be bearish. Okay, if it doesn't grab liquidity, you just got to see what market structure is doing. Okay, I don't know if it makes sense. It's very easy but hard to explain, if that makes sense. So if you have a question, put it in the comments. Even on Forex, this works. For example, Forex, I find it even cleaner, not gonna lie, where, for example, here you can clearly see body closure here failed to close under but grab the liquidity, you're bullish. Here close above, okay, grabs the liquidity. Here failed to close above, bearish. Here grabs liquidity and body closure under, bearish. Here grabs liquidity, as you can see, very interesting, grabs liquidity, body closure not under, so here I would have been bullish, and as you can see as a scalp trade, it still takes this liquidity here, and after it goes down, so still bullish would have been the right thing. Okay, here body closure under, failure, you're bullish. It's very easy. Of course, side note, when you do this, you gotta also pay attention to your market structure. So what I previously told you guys, liquidity, I'm gonna explain you after. Like, you gotta understand what market is doing and gotta adapt yourself. It's not because you see body closure under, you're gonna be bearish 100%. No, you need all those other confluences. It's very important. For my swing traders and day traders, how do I find my bias? I just watch what the market structure is doing. If you're a swing trader, you go on the weekly, and I just understand here you have a high, you have a low, a high, a low. So you're looking for buys. Okay, you're in a bullish trend here. You have a low, a high, a low, a high, a low. What do I expect here? Here's a new high. I expect a new low here, and I go take my swing trade. Very easy. That's the only way I find my bias. I just go with the trend. I never go against the trend when I day trade or swing trade. Very easy. Trading should be easy and not be hard. I just follow the trend. There's a high and we're in a bullish trend. I'll wait for a low and I go in there. Easy. Now that we understand what market structure is doing, where market is going, obviously you need to practice this a lot. Okay, then there's other confirmations you need to enter a trade. Okay, for example, there's liquidity sweep. I'm gonna go on a NQ, so that's a futures. It's a little bit cleaner, not gonna lie. We go to the 1 hour and let me show you what is a liquidity and what is a liquidity sweep. So what is liquidity? I'm gonna explain you this in a very simple way. Okay, there's different explanations. Liquidity is where the most stop losses are, where the most orders are placed, where basically whenever price action goes there, you're gonna have a reaction out of it. Okay, so liquidity, how can you spot it? Usually you find it with those wicks, where usually you know, price action went here, immediate reaction, and every time price action goes here, you have a reaction. So basically liquidity is a place where a lot of orders are placed, stop losses, and those big players, the big institutions, big companies, they want price action to go there before they take their trade. So basically they wait until the liquidity gets grabbed and then they go in. And that's where you want to enter your trade, because you want to move with those big players, you know. You don't want to go against them. You or me, we are nobody against them, okay? So how can you spot liquidity? What is a liquidity sweep and how can you use it? Let me explain. Liquidity, as you can see here, you can see this with those wicks. So for example, what I usually do is I mark liquidity on the higher time frames, always the 1 hour and 4 hour. Here you have liquidity, you see, liquidity sweep, because price action goes here, immediate reaction, and then it goes up, okay? So that's a liquidity sweep. As you can see here, those wicks here, all of this is liquidity. So whenever price action, you can see exactly, price action goes here, immediately reaction. You see, that's the point of liquidity. Liquidity is where big orders are placed, you know, big money, and there's going to be a big reaction, okay? So for example, you can have liquidity, you see, here is liquidity, okay? You see sometimes, and that's why you also need confirmation, liquidity gets taken, but if it's not that strong, if there's not a lot of orders, no reaction, okay? So I'm going to explain you more. I'm going to show you more examples. Let me show you more examples. Look, all of here is liquidity. You see, liquidity gets grabbed, immediate reaction, okay? So what I advise you to do is you mark out whenever you go into a session, okay? There's London session, New York session, Asia session, okay? You go in a session with the most volatility, so London or New York, you mark out your liquidity points. So every time price action goes to a certain place, you know price action is going to react to, and you mark it out. And then you wait until that key area gets hit. So this is liquidity, okay? For example, here is liquidity, exactly gets taken, and so on and so on, okay? Now, I'm going to go to another concept, which is called an SMT. I know you guys like this concept. On TikTok, I went viral for SMT. It's one of the strongest confluences you can have, in my opinion, and I'm going to explain you how it works. So for example, you have NQ, and let's say the S&P 500, hold on, we go here, ES, okay. So an SMT is when two correlating pairs, for example, ES and NQ, or EURUSD and GBPUSD, or USD and the dollar index, doesn't matter if you trade Forex or futures, is when two correlating pairs do not act the same way, do not behave the same way, okay? So basically, market is showing you, yo, there is going to be a reversal. Be ready, there is going to be a reversal, okay? The higher the time frame, the SMTs, the bigger the confluences is, okay? Obviously, a 1 hour SMT is stronger than a 1 minute SMT. Now, how does an SMT work? Let's say you have here NQ and ES. Look, let's say here the liquidity, as you can see here on ES, okay? So the S&P 500, here you have a high, okay? ES made a new high, grabbed the liquidity, as you can see here, okay? So that's the high of 9 p.m. Wednesday, 10 December, okay? For example, we go here, 10 December, 9 p.m. As you can see here, the ES failed to make a new high, failed to take this liquidity. You can see those are two correlating pairs. They always act the same way, or mostly, okay? But here it made a new high, here it made a new low, okay? You trade every time the pair that's the lagging index, the index that didn't grab the liquidity, the index, the future, the Forex, whatever you want to call it, that didn't make the new high or the new low. For example, here NQ failed to make the new high, you trade this pair. Why? Because that's the first pair that's going to move to your TP, to your take profit. Look, here, failed to take this liquidity, what happened? Immediately did this big down movement. Here, what happened? It take it out, consolidated, and then made the movement. You get what I'm saying? This one goes first to your TP, faster price action. That's the goal of trading. You want to be in and out, especially when you scalp trade, okay? So that's the SMT. Okay, now that we understand what is an SMT and what is liquidity, let me show you about support and resistance. So we're gonna go to a forex pair here, forex. Okay, exactly here again. So what is a support and resistance zone? An area of interest, whatever you want to call it. Okay, it's a zone every time price action goes there. By the way, I explain all those concepts because I use them and I find it very effective. Okay, so I explain them one by one. So either you can follow my strategy or make a strategy of your own, but you have more, a clear overview of what every concept means. Okay, so what is a support and resistance zone? Is every time price action goes to that zone, you have a reaction. As you can see here, for example, here there's a clear reaction. Every time price action goes here, reaction. You get what I'm saying? There is always a reaction on that zone. Doesn't matter on what time frame you can find it. That doesn't matter what time frame. Okay, the concept stays the same. For example, here you have a clear support resistance zone. Okay, resistance is like a roof. When price action goes there, it goes down. Support is when price action goes down and it goes up. So for example, here, when we are here, this is resistance because it's a roof. You hit it and it goes down. Support is when you are above it. Support, as a bottom, and then it goes up. Okay, basically that's a zone where you expect price action to pull back, to retest, to go back at it, and then have your reaction and enter your trade. Okay, so imagine you combine this zone with a liquidity sweep, two confirmations where price action could react off. You get what I'm saying? Exactly, something strong. For example, here, look, swept this liquidity here. You are at this zone, you are pulling back to it, so from down to up, liquidity sweep, reaction goes down. You get me? Exactly. That's the advantage of a support and resistance zone. I'm going to show you another example, maybe on NQ. For example, here, look, you have a clean example here. For example, every time price action goes here, you have a reaction, okay? Or even here. You want to mark those zones, by the way, with the bodies, not the wicks. You do not watch the wicks. Wicks is just for the liquidity. Look, here you have your zone, grabs liquidity, goes to your zone, immediate reaction. That's the power of a support and resistance zone, area of interest, whatever you want to call it. Then you have a fair value gap and inverse fair value gap. Okay, what are those? Fair value gap is when there's a lot of buyers on the charts, okay? A lot of buyers, a lot of price action momentum that it leaves a gap in the market. For example, here, it's a 3 candlestick pattern where you see, so 1, 2, 3, where you see the first and third candle do not close this gap. Here you have a gap, okay? And that shows that's a fair value gap. So this is a fair value gap. This right here. So fair value gap, literally the name says itself, this when the market leaves a gap, okay? So when there's a lot of momentum, sometimes it leaves gaps, and usually price action pulls back to that gap and then have a reaction. As you can see, here's a reaction, okay? For example, a fair value gap, here you have a fair value gap, exactly, price action goes there, reaction. Doesn't matter what time frame, you can find it on any time frame, okay? You need 3 candles of the same direction. For example, here, bullish, 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 that leaves a gap, and that's where price action is reacting to, okay? Now, an inverse fair value gap is when this fair value gap doesn't hold the price action. For example, here, look, for example, here, price action gets respected on this gap. So this fair value gap is still respected, is still valid, and it goes up. Now, an inversion, so an inverse fair value gap is when a gap does not get respected. Let me show you an example. For example, here, exactly. You have a gap here. Here you see bearish, bearish, bearish. There is a gap. No wicks that fill this gap, okay? You guys understand me, right? There is no wicks that fill this gap, so this is a gap. This here is not a gap, okay? Because there is no wick there's no actual gap, like the wicks are filling this gap. Inverse fair value gap is when this gap gets disrespected, like here, and then you see price action goes up. Okay, inverse fair value gap is one of the strongest reversal patterns you can have. You combine this with your SMT, like I explained before, and your inverse fair value gap, you have your strongest reversal pattern possible, in my opinion. Yes, there's more like valid opinions in trading or whatever. Like there's not one right answer, but in my eyes, this is like one of the strongest reversal patterns. Now the last concept I'm going to tell you guys before I explain like how you can apply it in practical, like how I do it on my own strategies. I'm going to maybe release like other videos with other trading concepts, but yes, this is the last one. There's a Fibonacci tool. What is a Fibonacci tool? It's a tool that retailers mostly use where there's key levels. Okay, so I'm going to explain you. I'm going to show you in a minute. There's key levels, and they expect price action to go to these key levels before continuing with the trend. For example, how do you draw your Fibonacci tool? It's this tool right here. So when you go on Trading View, here it literally called the Fib retracement. You click on it. If you're in a bullish trend, you go from your swing low to your swing high. So from your lowest point to your highest point. Okay. If you're in a bearish trend, you go from your highest point to your lowest point. Here you can see from your lowest point to your highest point here. What happens, retailers believe that price action goes always to those 0.6 and 0.7 level mostly. And every time it goes there, it's going to continue with the trend. So you can see here, 0.5 level, it gets hit, but it still goes a little bit down. But here you can clearly see the 0.6 level gets hit, and it's between the 0.6 and the 0.7 here. The price level here gets respected. You see consolidation, you have a liquidity sweep. Okay, you have a support and resistance zone. You have this level. Boom, massive upside. You get what I'm saying? Very, very strong tool. So you use it from your low to your high in a bullish trend, in a bearish trend from your high to your low. Let me find a bearish example so you get what I'm saying. Hold on. Okay, exactly here. For example, here when you use from your high until your low, you can clearly see here on the 0.6 point level, here it gets hit. Easy. I don't know if you guys can see it, but here anyways that's 0.5, here 0.6 gets hit and goes down. So you go from your high to your low. So now you're gonna be like, yo, trading knowledge, I appreciate all the knowledge, but how do I use this? This is how I use it. There's more than one solution, like I mentioned before. You can make your own strategy, but this is my scalping strategy, and this is also going to be my day trading and swing trading strategy that I'm going to share with you guys now for free. Okay, so again, please like and subscribe. Okay, join my free Discord. It will mean the world to me for sure. Anyways, how do I scalp trade? Okay, we're going to start with the scalp trading strategy. Even if you only scalp trade, you should listen to the day and swing trading strategy, because having an overview of the entire way I watch the market can help you a lot and increase, your knowledge. Anyways, I'm going to show you the examples on futures, so ES and NQ. Okay, let's say here we can clearly see here on NQ we have a low, a high, a low, okay, a high and a low. You are in a bearish market. Let's say we are here at the time for example purposes. Okay, I have no idea if it's the right session or whatever. Just I'm gonna show you. Okay, wait, here's Asian session. So let's say, yeah, here. Okay, so let's say we are clearly in a bearish trend. ES here is also on a bearish trend. Okay, first thing you want to do is understand where your market is going. Here you can clearly see NQ wants to go down. Okay, so consolidation, liquidity grab. Okay, we want to go down. Okay, market structure also is very clear where you have low, high, low. We want to go down. Okay, now you mark out your liquidity points on both charts. So here you have a liquidity point. You can clearly see here is swept. This is a liquidity point on ES. Here is also a liquidity point that got taken. Here's a liquidity point. Okay, you got your liquidity points. You can mark also support and resistance zone. For example, here you mark out this zone. Okay, so let's say we are here. Okay, first of all, Here you can clearly see you have your support and resistance zone. Here's a resistance zone, liquidity grab. Okay, you wait for your price action to go to a key area on a higher time frame. I hope you understand me. I hope you hear me. You write it, okay? Write it on paper. It has to go to a key area on a higher time frame, not the 5 minute, like 1 hour or 4 hour. Here on the 1 hour, you see resistance zone. It goes here, pulls back, liquidity grab. Okay, what happens on the 5 minute if you scalp trade? Let's see. Let's see what happens. Clearly, liquidity grab, and you have immediate reaction. Okay, immediate reaction. So you find a reason to enter your trade. You see a liquidity sweep, a clean liquidity sweep, and a reaction. So you find a reason to enter. For example, here, if you only base yourself on the 5 minute, you see nothing here. Here is just ugly price action. When your price action is bad, is ugly, why would you trade? There's no reason to trade. Wait for clean price action. What did I tell you at the start of the video? Price goes up or goes down. If it goes like this, consolidate, do not trade. This here, this is ugly, bro. We don't trade ugly stuff, you know what I'm saying? Anyways, it goes down. What do we see? Oh, here is a fair value gap that got created. Fair value gap means there is a gap in the market. Means price action is gonna pull back there, okay? And hopefully have a reaction. Fair value gap also means continuation pattern. What happens? Price action goes here and immediately go down. So when do you enter? You can scale down to your 1 minute. If I go to the 1 minute, I gotta find a market anyways. You go on your 1 minute, you can find a change of character. Remember what it means? You can find an inverse fair value gap on the 1 minute. If you don't understand what it means, go back at where I explained inverse fair value gap. Okay, an SMT inverse fair value gap at that zone, and then you enter. And then what happens? If there is your entry, you enter here. You either put your TP above the liquidity. That's a very safe trade. Or if you want a better trade, in this example, you put it at least at the body, at least above this fair value gap. And you always aim either a 122 RR, or if you don't like to work like this, you aim a TP where you think if price goes there, it might react to. But for example, here at the closure of this fair value gap, fair value gaps are meant to be closed, like be filled and then go up. So for example, here could have easily filled this gap and go up. In this example, not, but we are not visionaries, okay? We don't know what's gonna happen after, you know? This is backtesting, so it's easy to say and to cap, and I'm gonna explain, yeah, dip here. No, this is not the reality. In real price conditions, I would have dipped here at the fill of this gap, because here market could easily react to, and you still have your 122 RR, okay? New example. For example, let's say we are here again on the 1 hour, okay, higher time frames. You can clearly see here on the ES, grab the liquidity and Q didn't. You have your SMT. Again, this shows there's a reversal. Again, you should be interested in taking a trade at that time. You scale down to the lower time frames, for example, here. Okay, here is a massive gap, obviously. It's the day opening. Anyways, here, if there was just an SMT, for example, oh, very clean. Okay, it didn't happen here, but so you guys can learn. SMT, here's a fair value gap. If this got inversed, you know you can enter. Stop loss here would be above here the SMT, always above your SMT, and then TP here at your liquidity point. Very clean trade. Very easy. On a scalp trade, I mainly enter either if I do a reversal trade, okay, it's liquidity sweep. I find my zone, okay, and then I look for an SMT inverse fair value gap, or a change of character and a fair value gap on the lower time frames. Basically, higher time frame, I want a liquidity sweep, okay, for reversal, and then I scale down to my lower time frames. If I continue with the trend, so for example here, highs, lows, highs, lows, highs, lows, very easy. I scale down to, for example, the 4 hour one. Let's say here on the 4 hour, I'll just wait for it pulls back to a fair value gap. Here it respects this fair value gap, lower time frame you enter, and you continue with the trend. When the trend is very clear, it does highs and lows or lows and highs. You don't want to take a reversal trade or whatever. Just continue with the trend. Don't make trading hard. Go with the trend. If market is clearly telling you it goes up, why would you reverse the trade? Okay, let me show you a reversal trade, a continuation trade, my bad, a continuation trade. There was a big accumulation here on NQ. For example, here, perfect example: low, high, low, new high, change of character. We know we're bullish again. Fair value gap. Here's the fair value gap. You draw the fair value gap. Market is clearly showing you we want to go up. Don't reverse here or whatever you want to do. No. 15-minute fair value gap, 15-minute respected. Probably on the 5-minute you have an inverse fair value gap. You put your stop loss under here, either the wicks or here, and you aim either a 1 to 2 RR or just previous liquidity here. You see, trading is easy. Trading is easy. You get what I'm saying? You just continue with the trend. Lastly, how do I day trade, swing trade? Okay. Fun fact, I'm going to switch to day trading and swing trading way more in 2026. Why? Because it's higher time frame, so less risk. Okay. I take less trades in a week so I can focus more, on the YouTube channel and so on. Bigger moves means bigger money. Get what I'm saying? So I'm switching to my day trading and swing trading strategy full time. If you guys want to have like more examples of this strategy, I posted a lot of YouTube videos, like live day trading videos on YouTube, where I made like some good money. So yeah, you can learn from it for sure. Okay, now how does my strategy goes? If I swing trade, I care about the weekly and the daily time frame market structure. For example, here market structure is clearly going up, down, we're bullish. On the weekly, here you can clearly see we are going up, down, so you expect to go up. Okay, so I understand where the trend is going. I understand here my market structure is bullish. I mark out on a daily time frame or 4-hour time frame a zone where I'm interested to buy or to take a trade, or where I know price action could react off. Okay, for example, here in this scenario, if we go example like this example right here, here is a strong arrow, because every time price action goes here, there's a reaction. Okay, so then you scale down to your 4-hour time frame, 1-hour time frame. Okay, wait, let's put this as an example purposes, because here there was a trade, but this move is because of news, so I never caught this move. But let's say okay, so here there was a zone, exactly because I took this trade. On the daily here, okay, there was also a zone, because you can see if I put it more to the left, reaction. You see, if your daily and your 4-hour time frame zone correlates, it's the one of the strongest areas where price action could react off. Okay, so very easy. You know your weekly time frame trend, daily time frame trend, and your 4-hour time frame trend. Here again, highs, lows. Now you start to get me, you know what I'm saying? Now, if you still don't understand it, go back to the start of the video where I explained how market structure works, because if you don't understand this, you're never going to make it in trading. This is the most important thing in trading. Anyways, we know we're bullish and we found our zone. What do you want to find? What do you want to see if you want to take a trade? You want to see that, for example, in a bullish market, the price action goes like is above your zone and pulls back to your support zone. Remember, support is for bullish, resistance for bearish. Here pulls back to your support zone, and then you find a reason to enter. You have your zone, you have a 4-hour fair value gap. Okay, so you have a zone, you have your trend, you have your 4-hour fair value gap. This is a perfect zone where price action will react to. It will. I'm almost always sure. Okay, even if after it goes down, there's still gonna be first a reaction. So you scale down to your lower time frames, for example 1 hour. On the 1 hour, you want to see something very clean. You want to see, for example, first a little bit accumulation, a liquidity grab, a liquidity sweep, and then after that you enter. Okay, so for example here, clearly you have a low, so you have a high, a low, a high, a low. Okay, so we're still bullish here, right? But it also grabbed all this liquidity. Scale down then to your 50-minute time frame. On your 50-minute time frame, for example, here in this case, I went to the 50-minute time frame. You see a liquidity sweep. It failed to break under, a change of character, a pullback on this fair value gap. reaction and went here, stop loss under, TP at next liquidity zone. So basically, if you guys want to see more examples, go watch my other videos where I do those live day trading videos. But very easy. You want your trends on the daily, on the weekly. You want to mark out your support and resistance zone, your area of interest, doesn't matter, whatever you want to call it. At that zone, you want to see a fair value gap, for example, or if there's no fair value gap, you want to at least, or there's always going to be a fair value gap. If not, it's maybe not that interesting to take a trade. Anyways, you want to find your fair value gap, you want to see it respected, you want to see a liquidity sweep, a liquidity grab, and then you want to find, for example, an engulfing. What is an engulfing? I didn't mention this. An engulfing candle is when, for example, here you can see this candle, bullish candle, eats this bearish candle. Yes, I use eat. It means there's more buyers in the market than sellers. That's a beautiful sign. The market is going to reverse, okay? An engulfing is a sign of reversal. Here, bullish engulfing because it eats this bearish engulfing. A bearish engulfing is, for example, here where we eat this bullish engulfing and you see it always goes down, okay? And the higher the time frame, the stronger it gets. So when you have your zone, trend, liquidity sweep, fair value gap, you scale down to your lower time frames. You want to see a change of character, that the lower time frames correlates with your higher time frames trends. And then you find an entry. It can be an engulfing, an SMT plus inverse fair value gap, change of character, and a pullback to your fair value gap. Doesn't matter. I hope you guys understand the value of this YouTube video, because most traders are lost when they trade, okay? And when you are lost, you're going to lose money, okay? If you understand what market is doing, you have an edge above everyone else. And those are like maybe 5% of the trading concepts you can understand, like you should know. You know, there's like way more other concepts, but those for me are mainly the most important ones, okay? So hopefully this helped you, okay? If you don't understand, just pull back, you know, rewatch the video, save the video for later, okay? If you have a question, put it in the comments. You can always join my free Discord group, okay? There you can ask me anything. I'm building like a community where everyone can help everyone. So that will be great if you join. Leave a like. Please subscribe. And stay safe, boys. 2026 is going to be your year for sure if you stay locked in. So stay locked in. And see you all next time. Peace out.